A common question I get asked is, Azul, how am I going to replace the income that I'm making now so that in retirement I can maintain my lifestyle? And so in today's video, I'm going to share with you one of those strategies, which is using dividend stocks to replace some or all of your income, depending on where you're at with your savings. So let's go for a walk and talk about it, and stick till the end because I'm going to share a couple other alternatives outside of dividend paying stocks. But let's start with the dividend stocks. So how do you generate, in this example, $2,000 a month in dividend paying stocks so that you can replace some of your income, and between that, maybe your spouse's or partner's Social Security, your Social Security, you can feel like you have a monthly income coming in that gives you breathing room, that gives you the kind of income that you want in retirement to live the lifestyle that's important to you. So in the example of $2,000 a month, that is $24,000 a year. And I would say on average, for good quality dividend paying stocks, you can plan on about a 4% dividend return. So to generate $24,000 in income, you would need about $600,000 in savings. Now, with dividend stocks, it's not just a return on your money, that 4% that I mentioned, but it's also the return of your money that's super important. So one of the things I like about dividend paying stocks is if you choose wisely, good solid dividend stocks have a history of increasing their dividend at a rate higher than inflation. So today, if you're getting $2,000 a month, maybe in 10 years, it should still feel like you have the purchasing power of today's $2,000 a month. Now, that doesn't mean each and every year the dividends are going to keep up with inflation, but over history, good quality operating companies, not financial engineering companies, but operating companies, companies that are producing a good or a service that people are buying, and they have excess cash above and beyond what they need to reinvest in the company. Those types of companies tend to generate dividend yields of about 4%, and they tend to increase that dividend yield at a rate higher than inflation. Now, you can get 8%, 10%, 12% dividend rates, and that might sound really exciting, but there's a reason that you're getting that kind of dividend rates. And most of us should not be buying those types of companies. You've got to be very careful. You've got to do your research on those companies. There are people that can do that successfully, but to me, it's much more about the return of my money. And so for that, I like just owning great companies for the long term. This channel is not about mentioning specific company names. This is not financial advice for you. I don't know your situation. I cannot give you financial advice. But what I can say is it's worthwhile to pay somebody that is a dividend stock investing specialist, that has been doing it for decades, that has a good track record, and whose strategy you believe in. And you can look at and say, okay, what's happened over the last 20 years is something I'd be comfortable with. They have the same discipline, they have the same strategy, they have the same team in place. And so maybe you're comfortable with that as well. By the way, very quickly, behind me is the hotel where Victor Hugo lived for many years after writing the book Les Miserables, which he was paid the highest price for any book at the time. So he rented out the second floor of this hotel behind me. Okay, let's keep going. I just thought I'd mention that quickly. So again, it's good quality companies. It's return of your capital, return of your investment, as much as the return on your investment. And I think targeting good, solid operating companies is the way to go. Targeting something in the range of about a 4% dividend rate, and hiring a professional that's been doing this for decades, that has a strong history of it, that has a strong team. I think that's the way to go. You know, a lot of people like index funds. There are index funds that target dividend paying stocks, but I think you want to be careful because there tends to be two categories of dividend paying stocks. One are solid operating companies, which is what I prefer. Companies that have a great brand name, have a great competitive position, strong balance sheet. They're not borrowing money to pay the dividends. So that's one category. The other category of dividend paying stocks use what I call financial engineering. So they're actually borrowing money in order to be able to pay that dividend to their shareholders. And I think you want to be careful. You want to be careful with that because I think that's a much riskier strategy. You want companies that are generating their own capital because they're solid companies and they're going to be around 20, 30, 40 years from now. Again, this isn't about specific names, but you know, things have to get pretty bad before we quit buying, you know, a $1 can of soda from a brand name company. I'll just leave it at that. Or things have to be getting pretty bad before we give up our cell phones. So, you know, top manufacturers of cell phones, probably if they're a leading manufacturer now, they have leading technology. Those types of companies used to not pay dividends in the past, but they are now. So I mentioned dividend paying stocks, but really what people want is cash flow. And so if you're looking for cash flow, another alternative that people think about is real estate, right? If you look at that $600,000 that I mentioned at a 4% dividend yield, that's going to generate about $24,000 of income. You don't have to do anything for that income. You don't have to replace water heaters. It's not an active investment on your part. You could also invest in a small private company, you know, a local franchise or something like that. Unfortunately, that can be pretty risky. Again, you're worried about the return of your money. So then the category that tends to be the most common and the most used when you want cash flows in a situation like this is real estate. So can you generate a 4 or 5% yield with real estate? I think you can. I'm not a real estate expert, but I know a lot of people are able to do that. You know, real estate's had a really good run. Is real estate going to continue to do as well as it has in the past? That's not my expertise, so I don't know, but there's a reason that the SEC has financial advisors and investors say that past returns are no guarantee of future return, but that tends to be the next area. Now, you want to be careful with real estate because you can get a fair amount of leverage, right? You can put 30% down on, let's say, a $500,000 house. So you're putting $150,000 down, you're borrowing $350,000. But if the market moves against you, or if that place stays empty for a while, or if it needs repairs, that can get painful quickly. So one of the nice things about dividend stocks is you can hire the expertise. You don't have to worry about putting in the time and the effort to keep it in good operating experience like you do with rentals. I hope you enjoyed this video. If you enjoyed this one, I know you're going to enjoy this video here that talks about the average income for retirees. Thanks for watching this video, and I'll see you in this one in a moment.